at the council's internet site. You all know that by now. So the only apologies will be from Councillor Andy Eiling, then I think Councillor McGonagall's here. Yep.
Yes.
Do we have any declarations of interest or transparency statements?
John,
No.
Councillor Shaw, Dave McGonagall here. Question for you. You mentioned Aberdeen a moment ago, I think. Is that Aberdeen Asset Management?
Well, it was Aberdeen who were formerly Aberdeen Asset Management, who are now LGT. It's kind of explained in the papers, David. They've been bought out or taken over. LGT have bought out that part of Aberdeen's business. The
reason I ask is I currently do work for Aberdeen Asset Management. So if that's a separate entity now, then I don't have a conflict of interest. If it's still part of Aberdeen, then I have a conflict of interest.
Well, as far as I understand it, it's entirely separate, but we can, who wants to talk on this one? Craig's nodding his head here, so it's entirely separate. It's been...
Right.
We're novating the contract over to LGT now, David, so it's not even the same contract anymore.
Right, I just needed to ask the question.
No, of course. Okay.
Thank you.
Item 1 on the agenda is the minutes for the previous meeting. Do we have any questions or comments? Can we agree the minutes? Item 2 on the agenda is it... Sorry, did somebody say something there?
I just said agreed, John.
All right, sorry. Item 2 on the agenda is Paisley and Renfrewshire Common Good Fund's 6 months report, 30th of September. We've got David Watson from Hyman's here. You haven't changed your name, David? No.
Still the same person.
Right.
Sure. Thanks. I mean, I can share my screen and just sort of get into the. Hopefully, you can all see that. Cheers. Yeah. So thanks, and similar to previous meetings, I'll go through the report into the income and performance of the Common Good Funds, both the Renfrewshire Common Good Fund and Paisley Common Good Funds for the past 6 months from March to September this year. I'll start by just giving a high level summary of what's happened in markets over that period and then touch more on the performance of the funds. Before starting, I will say I'm happy to take any questions as I go through or later on in the meeting before passing on to Craig from LGT. So starting on the second slide with a bit on market background, and if I think back to the last meeting that we had in June, Ben had mentioned that global growth had proven more resilient than expected in the year to date, and that has pretty much continued throughout the prior 6 month period. Whilst we've seen global growth slowing versus what it was last year, essentially that slowdown has been less than what people were expecting at the start of the year. I think one of the main reasons for this has really been that consumer spending has held up well, and that's been for a variety of reasons, but notably fiscal support. So if you think to some of the support that governments put out with regards to energy prices, also the savings that people had previously built up over the pandemic has helped support consumer spending, and then additionally tight labour markets. So whilst you've seen unemployment rising, it is still low compared to when you look at it historically. This consumer spending has really supported continued growth in the services sector activity. However, we do know that manufacturing sector, which is more sensitive to energy prices and interest rates, has seen negative growth over the year. And you are starting to see more recent signs that growth in services is also slowing. So on the slide, we have charts on the left showing the 6 month, 12 month and 3 years returns for major asset classes. I think as you can see in this top chart with those initial blue bars, that resilience and growth mentioned has really benefited equities over the prior 6 month period. We've got global equities rose 4.4% in local currency terms and 4.3% in sterling terms. Just as a reminder, the difference between the two is really accounting for the change in exchange rates over the period. North American equities modestly outperformed with a 5.2% return in local terms or 6.5% in sterling terms, as you can see in this light blue column. One of the reasons for that is that the technology sector was the best performing sector over the past 6 months. And apologies jumping about a bit here, but you can see that in this chart on the bottom right, with the technology sector showing the strongest performance of all the other sectors. The UK market underperformed over the 6-month period, and some equity markets were weaker over that period, notably Europe, when you exclude the UK, underperformed. As mentioned, manufacturing activity has been weak over that 6-month period, and this has particularly hurt Europe, given it tends to be a quite manufacturing intensive economy as a whole. We also had Asia Pacific and emerging market equities underperform. We've seen continued troubles in the Chinese property sector, and disappointing Chinese activity data has really sort of weighed on the returns of that region and broader emerging markets over the past 6 months. Turning to a bit on market environment, and I'm sure inflation continues to be the topic at the forefront of everyone's mind. Though we have seen headline of inflation generally come down, core inflation remains stubbornly above central bank targets. So focusing on headline consumer price inflation, that was down to around 6.7% in the UK and 3.7% in the US at the end of that 6-month period. And that compares to over 10% in the UK and over 5% in the US at the end of March. Core inflation, which excludes energy and food prices, which tend to be more volatile elements of inflation, has fallen less, as I noted previously. In the UK, it was down at 6.2%, down from 6.2% in March to 6.1%, and down 5.6% to 4.1% in the US. So yes, come down, but not as dramatic as the falls that you've seen in headline inflation. As central banks have continued to battle that high inflation over the 6-month period, we've seen continued rate rises from them. So the Bank of England raised the bank rate by 1% to 5.25% over that 6-month period. Likewise, European Central Bank had raised its main deposit rate by 1% for that period to 4%. Whereas the Federal Reserve continued hiking, but it slowed its pace of hiking, just given sort of greater progress against inflation in the US. So the Fed had only risen rates by 0.5% to 5.5% over that 6-month period. We do know that both the tone of central bank comments and market pricing is suggesting that policy rates are at or close to their peak now. But it does seem that the subsequent cuts that were being priced in may be more gradual than people have previously thought. Given that inflation and rates picture over the 6-month period, we've seen UK and US 10-year yields rise around 1% to 4.5% and 4.6% respectively. German yields also rose 0.5% over the period to 2.8%. So this rise in yields has hurt bond performance over that 6-month period. As you can see by the chart, UK gilts were down around 6% over that 6-month period. Overseas bonds were down 5.7%, and UK investment grade corporate bonds were down nearly 1%, as that rise in underlying gilt yields more than offset falling credit spreads. Finally, touching on property markets, the UK property market rose 0.8% over that 6-month period to end of September, as the income provided by the property side, rental income, more than offset a fall in the value of the properties. We do know that property values in the retail and industrial sectors have stabilised in recent months after significant falls prior, but we have seen values in the office sector continue to decline. Moving on to the performance of the funds on slide 3 with the Paisley Common Good Fund and slide 4 with the Renfrewshire Common Good Fund. Over the 6-month period to September, the funds performed negatively with a 2.9% fall in value. This contrasted with the benchmark performance, which was positive 0.8%. Performance over the 3 months to June was slightly negative at negative 0.5%, which is pretty much in line with the benchmark performance. However, that negative performance over the whole period was primarily driven by the returns in the latter quarter, so the 3 months to September, which was minus 2.4%, and quite significantly below the benchmark performance of 1.2%. The underperformance against the benchmark was mainly driven by the performance of overseas equities in the portfolio. There's several stocks in the portfolio that have fallen in value over Q3 this year. Within the portfolio, there were overweight positions relative to the benchmark, so that's why you've seen that quite significant negative relative performance. I do note that the managers has said that a lot of these companies have been stronger performance over other time periods, and I'm sure Craig will touch on this more in his report in terms of some of the drivers for that negative performance and the outlook for these positions and whether there's been any changes made to the portfolio as a result. This more sort of recent negative relative performance has also dragged down the longer term relative performance, with the returns for the Renfrew Common Good Fund now just marginally ahead of the benchmark since inception, and returns for the Paisley Common Good Fund essentially flat on the benchmark. So these columns here, you can see that in. That says when you think on performance in absolute terms, the fund has returned over sort of 6% per annum since inception. One position of the fund, again, I'm sure Craig will touch on more on some of the drivers here too, but there has been a shift in the allocation of the fund. If I think back to previous meeting when we were looking at position at the end of the March, the equity allocation stood at over 83% in both the Paisley and Renfrew Common Good funds, and this is now down below 79% in each fund. The flip side of this is the growth in the bond allocation, which has went from around 15%, now close to 20% in both funds. And Craig did mention at the previous meeting in June some of the reasons why the team had been increasing the bond allocation, just given it was viewed as attractive, and is clear in terms of the change in positionings coming through, as equities had been overweight relative to the 80% benchmark target and bonds underweight to the 18%. But this is now flipped the other way, where there's a overweight to bonds in the portfolio and underweight to equities. The last note from me is just around the estimated annual income for each fund as at the end of September. Whilst it has come down a bit from end of March, it remains well above target at just over sort of 143,000 in the Paisley Common Good Fund and around 550,000 in the Renfrew Common Good Fund. I mean, both above the respective targets for each fund. Happy to take any questions here, as I say, or otherwise I'll pass on to Craig from LGT to get into more specifics around the performance and positioning of the funds.
Okay, do we have any questions, comments? No, Craig.
Thanks.
Well, thank you. Good morning, everyone. I was wondering if somebody would be kind enough to pull up the presentation pack, or if you all have it, I'm happy to work through the slides.
I can try and do it here. Let me just. Is that working?
That's great. Yeah, I can see it clearly. Thank you.
Just tell me when you want to move on.
If you can just move a page on, please. Firstly, Geir, who's the lead manager, sends his apologies. He had a long-standing commitment that he couldn't change. And of course, I think I met with you all, I think 6 months ago or so. I thought I might just touch briefly on the completion of the acquisition of Aberdeen's discretionary business by LGT, the current owners of the business. That completed on Friday 1st of September at 5 p.m. As we would have mentioned before, 140 out of 145 within the discretionary team moved across. So that's included frontline individuals like myself and Gear, our assistants, our discretionary investment team, and also the operational role. So this is not a slash and burn exercise from LGT. This is very much a sort of a lift and drop, and then wanting the expertise of the wider team. So I thought I'd just mention that, just for reassurance that very little changes looking forward. If you could move on a page again, please. David has already touched on a lot of what's happened here. 3 months is a very short period of time, so I thought I'd just concentrate more so on the left-hand side of the page. These are the 1-year sterling returns to the end of September. Those returns in sterling are within the blue bars. And if you look to the geographic regions, there's also the local currency referenced as well. If we look to the top two sections, that's gilts, so that's UK government bonds or overseas bonds. It's been yet another difficult year for fixed interest. So this is a global issue. Fixed interest does tend to underperform in an inflationary environment. In an inflationary environment, interest rates are typically increased, as has been the case and that David has commented on. But one area I wanted to draw out was these currency moves, and probably no better highlighted than if you look down to North America. You can see to the right of that, there's 21.2 is the percentage increase in the North American index in local currency, so dollars. However, when you look at the return in sterling, it's 10.9%. So really, that's all due to the strength of sterling over that period. So translating into from dollars into pounds, reducing the return. But it has been, on the whole, a slightly better year. And if you look to the right-hand side, just briefly, you can see again that it's been a period in which more of the major asset classes that we look at have provided a positive return. If we could move on one more page, please. So just going back to basics ever so slightly, just to talk about the inflation challenge and why we find ourselves in this situation. If we work from the left-hand side to right-hand side, so what prompted the increase in inflation? Well, there was the COVID lockdown in China. It was impacting supply chain issues. Containers for goods moving around the world were often in the wrong place. After that, we then had the war in Ukraine. That was pushing up gas prices, oil prices generally. And of course, with also Ukraine and Russia being the breadbasket of the world, also things like the grain, but not only that, fertilizer as well. And of course, if these input costs are increasing for a short period of time, it doesn't really feed through into higher costs at the time we're buying our fuel, cooking the bread, transporting bread, buying it in the supermarket. But of course, inflation has been a good bit higher than we expected and for a good bit longer. The second leg of that is that people start to feel the pinch. It's a cost of living crisis. People have less money in their pocket, and therefore you have wages going up. What we're also finding is, as David mentioned, is that people have been quite comfortable to move job in the expectation of trying to get slightly more by way of income. Anyway, to combat all of that, on the right-hand side of the page, what we've seen is, interest rates have been increased. We too also think they have peaked. Our view now is that they will reduce probably sooner than we would have thought a month or two ago. Now, it is a blunt tool. What does that really mean? If interest rates go up today, it doesn't impact everybody. Mortgage holders typically feel the brunt of that. If you're tied in for a long period of time at lower rates, then that's a bonus. But of course, most months, there's always a certain number of households where their mortgage needs renewed and they feel the pain of those increased rates. If people have less money in their pockets, then of course less to spend on a discretionary basis, whether that be for clothing, going out, so on and so forth. So that will reduce growth. And of course, the fear is that if the central banks, so the Bank of England and the US Federal Reserve, put interest rates up too much, it can force a recession. An element of slowing is welcome, but a deep recession or a prolonged recession is not what anybody would wish for. So if we can move on one more slide, please. So to think what's been happening in the portfolio, and David, thanks for the segue into that. Well, cash is an asset class we haven't particularly liked in the past to seek a return, because interest rates for such a long period of time have been so incredibly low. But we have increased cash slightly, and we're being paid a bit more to hold cash. The other slightly more defensive area would be bonds. I think for a long time there was a minimum of 15% allocation placed upon us as managers for the portfolio. We didn't particularly like bonds. A bit like cash, we thought the returns would be modest. But the value of bonds has fallen, and we've now seen them as being slightly more attractive. So we have increased that bond allocation. And so if we've increased cash slightly and we've increased bonds, what has changed? David referenced the slight reduction in equities. Within that kind of equity allocation, we also include our alternatives. And it really is that alternative allocation that's been reduced. So what are these alternatives? They are renewables, so solar and wind, and also more social infrastructure. So that would be the sort of the PFI projects, the schools, the hospitals, and so forth. So why have we reduced alternatives? Well, in the past, you may have been received an income of 5 to 6%, whereas from your bonds, the return might have been 2 or 3, so quite a difference. And we felt there was a benefit by having increased income or from renewables and property. But now the two are very much similar. So in that sort of 5 to 6% for both of them. And bonds are slightly more defensive asset class. So with taking less risk but potentially getting the same return, we've decided to sell down that alternative allocation. If we could move on one more slide. So in terms of themes, I have broadly touched on in the last 6 months, last 12 months, in fact, it's the dramatic rise of inflation. It's the aggressive action of central banks and interest rates that have been the big and dominant force in the market. The higher for longer really reflects that inflation has been far higher and for far longer. And interest rates, again, have risen much more than we would have foreseen 12 months ago, but it is having an impact now. And so the wider economic impact is that economies have been resilient, and it has been that drawing down of cash that individuals have. It won't last indefinitely, and actually rising interest rates will still be felt for a good many months, if not a couple of years from here. So how does that feed through into portfolios? Well, earnings have been resilient. And to give an example, even if the volumes of goods for certain companies have fallen, companies have that ability, if they want to increase the prices of their goods. And so if you think of companies like Unilever or Procter & Gamble that make household or personal hygiene goods, they've actually have seen the volume of goods sold, but they've managed to maintain their sales by increasing the price of those goods. And that's been certainly beneficial in the portfolios to date. Okay, if you can move on one more slide, please. Yes, so if we then look to the investment guidelines for the portfolio, you'll see there's an up-to-date valuation as at the 13th of November, and also the estimated annual income, so that 570,000 of income for the Renfrew Common Good Fund is above the target of 475, and for the Paisley Common Good Fund, that target, the income of 149,000 above the 125,000 target. Investment restrictions I can touch on towards the end. It's in the appendix. Happy to touch on that. But then to look to the composite benchmark here, you can see the FTSE Government All Stocks Index, or UK Government Bonds or Gilts, that's 18%. The FTSE All Share Index 60%. The FTSE World ex UK, that's really our overseas equities, that's 20%. So that's 60 plus 20 is 80% allocation to equities, and 2% SONIA is sterling overnight interest average. That's still relatively new. It used to be called, or the equivalent was called LIBOR. So if we look to the right hand side of the page, you can see here that the portfolios have a weighting of 8.2% to government bonds, 11.1% to corporate bonds, broadly in line with the benchmark 18. And then in terms of equities, next section down, so UK equities at 27.8%, that does include the alternatives, and overseas equities at 50.8. Just as a reminder, we tend not to allocate by geographic region. We don't think about the UK and then the US and Europe. We are thematic investors. We are looking for the sectors, the themes that we think will change and drive the future ways of working and living and discretionary spend. And our job is to try and find the best companies that meet those kind of structural drivers going forward. Geographic region is very much secondary. There's then cash at 2.1% in the portfolio versus the benchmark at 2%. Just briefly referring back to the left-hand side of the page again, the level of risk being taken is medium-high, so no change there as far as we're aware. The time horizon is ongoing or long-term, reflected as 10 years plus, and the capacity for loss of capital is 20 to 30%, and that capacity for reduction in income is 10 to 15%. But as I mentioned just a moment ago, that we are a good bit above the level of income being generated versus the target, which is pleasing. So if we're to move on another page, please. There are values here at the 30th of September, the 30th of June, and the 31st of March. Mentioned a moment ago that the value of the portfolio was 17.568 million. That's the 13th of November. And just to touch on that move, the Paisley and Renfrew portfolios are up about 4.7% in this month, which is quite a move. The portfolios are up about 4% in this year. And what has happened is again, as David mentioned, that it looked like inflation is coming under control, and the interest rates going up have done their job to some extent, albeit it's very early days. And in the prospect now of the next interest rate move being one that's down the way, not up the way. And that's been well received by broader markets, really across asset classes. So the fixed interest element has risen in value, the alternatives have risen in value, and indeed it's given equity markets a boost as well. If we look to the bottom half of the table referencing performance, so we are a little behind over 3 months, and similarly over 1 year. So the top line there of 3.1% and 3.0% versus the ARC Charity Steady Growth benchmark of 5.1%. And Probably a couple of things that will have impacted that. I will touch on in a moment, some of the companies that performed less well. There's also been a couple of structural points to reference. It's really only latterly, probably the last 6 months or so, we've liked fixed interest and been increasing that. We had for a while been holding the minimum weighting of fixed interest, which we were less keen on. It did underperform, and we were adding to it, but also not having fossil fuels in the portfolio will have also been an impact. And that's certainly seen in the 3-year numbers, where you can see the top 2 lines, 5.8% and 5.6%, versus the peer group, the ARC peer group, at 11.3%. And over 5 years, the portfolio performing 18.5% and 18.3%, and the peer group returning 15.2%. So certainly a more challenging last couple of years than the prior period. What I would class as the medium term returns are still good, and I do think that not having oil and gas, particularly in 2022, was a detractor from performance. If we could move on to the next page, I think we've broadly covered the top section, which really looks at the allocation to equities, to bonds, to alternatives, and to cash. I wanted just to spend a moment to explain the areas that we like. If we look to the left-hand side bar, it's technology. So technology is an area that we do like. You might have heard of the Magnificent Seven in the news about what's been driving markets, and that's Meta, Nvidia, Tesla. Those are 3 companies we are less keen on. Alphabet, Amazon, Apple, and Microsoft are the others within that Magnificent Seven. They've been a fantastic driver of global stock markets, but just to give you an indication, the top 10 global listed companies just now, they account for 32% of global stock markets. Now that number has always been between about 20 to 25%, back to about 2000. So what you've seen this last little while is talk of AI, which is very much in the news, the next leg of this technological revolution. We still think it's quite early days. So we like Amazons and the Microsofts of this world. We don't like Tesla, where there's a very large valuation on that company. We think it's too expensive. And Nvidia, is still relatively new and it's a bit of a bumpy ride, albeit it's performed very well this year. If we also then look further along there to healthcare. Healthcare is another area that we like as well. So names like AstraZeneca, and names like Eli Lilly. Eli Lilly was in the news this year in relation to Alzheimer's and the development of their drugs. I think that was back in March and again in August. So again, these are the areas that we think are going to change the way in which we live, and the discovery of blockbuster drugs is something that we want to harness within the portfolio. Okay, if we could turn on one more page, please. And then to look to the top 10 holdings. So the left-hand side of the page includes fixed interest and equities, and the right-hand side just details the top 10 equities. So the largest position is the Volare Offshore Sterling Fixed Interest Fund, so that's fixed interest. Volare is a name change. It was previously called Aberdeen. Volare is just the name that LGT have given these funds. But you can then see below that AstraZeneca, Microsoft, well-known names. ASML, I think Gail Brisbane has talked about in the past. So that very much is looking at the machinery that etches the lines on the semiconductors. So if you don't want to back Samsung or Apple, you're not sure which one will have the best marketing campaign, then you go maybe slightly further down the food chain and you just choose a company which is delivering very, very high quality, cutting edge goods that delivers their technology into lots of different semiconductor manufacturers and lots of different electronics providers. Mercedes-Benz is another well-known name. There's Amazon, another company that's performed well, and Schneider Electric is a company we like with great credentials in relation to the way it's the electrification and the upgrading of industries to make them much more efficient. And if we move on one more page, this will then start to talk about what's been driving some of the performance. So the left-hand side, top performers first. Eli Lilly, I mentioned, I think the share price is up about 55% year to date. The news of Alzheimer's drugs fantastic. The likes of Alphabet really has been riding that crest of a wave in relation to technology. Relex is the old Riedel Elsevier business and sort of publication of journals, sort of legal, medical. Persimmon is one that's now no longer in the portfolio. So we sold out of that because we did think eventually, I think it was maybe July, we thought there would be more headwinds for that company with interest rate rises coming through. If we look to the right-hand side, and there's some companies there that I will touch on that have performed less well. Adyen really is a payments business. It's one that probably ever so slightly overstretched itself in terms of its capital expenditure. We think it will come good. It's investing for tomorrow, but it wasn't taken particularly well by the market. Ørsted is a very interesting one. So Ørsted is the world's largest provider of offshore wind. There's a couple of headwinds it faces, but one of them is the likes of Exxon, Shell, BP are trying to move into renewables. Those companies are awash with cash just now from these supernormal profits, and it is making it slightly harder for Ørsted to look forward and with as much certainty about the success of going into these markets, especially if it has to borrow money out in the marketplace. Do we have enough companies and enough expertise to deliver all the renewable wind power we want? The answer really is no. So the long-term drivers for this company are still there, but it's been a very challenging period for the company. To mention a name that we have sold, so Estee Lauder, you can see there, is one that we've sold quite recently. We sold it a couple of days before its results came out. The spending, this is a bit of a play on China. The reopening hasn't quite been taken as much as we thought. That's the reduction of their zero COVID policy and then returning to normal living. It's one we thought we would sell. By contrast, ASML is the one that we've kept. And we still just think that because there's huge demand for cutting edge technology around semiconductors, we think it'll be a bumpy ride at times for ASML, but it's a company that we see very much at the core, as indeed do we see Taiwan Semiconductor Manufacturing Company. Do we think we'll need more semiconductors in 3 years, 5 years, 10 years than we currently use? We think undoubtedly yes. So there are some companies there that when they underperform, we assess, we either top them up or we sell them. And there's others we essentially are on that journey, and we think the value will be realised over time. I thought I might just stop there. I'm conscious I spoke for probably long enough, and I'm very happy to answer any questions.
Thanks, Craig. Are there any questions or comments? No questions or comments. I thought it was a really interesting presentation, Craig. Thanks. Okay, that's us for. I can just find my agenda again. So item 3 in the agenda is the Paisley and Renfrew Common Good Fund review of investment policy statement. We Christine, do you want to talk about this?
Thanks, Chair. If it's all right, I'll just bring in Jeff briefly to introduce this paper.
Okay.
Thank you.
Thanks, Christine. Hi, good morning. Yes, this is just the annual renewal of the investment policy statement. The last time it was reviewed was November last year. The only changes made to the document from last year is just to reflect the changes that we've talked about. The Aberdeen's now under LGT, so the document's been updated to reflect that. So it's just really for review, comments and approval.
Okay, any questions or comments? We're happy to approve the statements. All right. I think that's us then. The next meeting is the 12th of June. Thanks very much, everyone, and we'll see. Well, we'll see all our investment reviewers in June. We'll see the rest of these beds much sooner. Thanks, folks.
Thanks, everyone.
Thanks, everyone.
Bye.
Thanks, Paul.